We are on the brink of a housing dip. The monthly change has been heading down for the past few months, and we're now finally on that tipping point where the prices year on year are now only 0.1% higher than what they were this time last year. The question is, will we see a dip or will we see a crash? And what is going on in the property market this year? There are lots of reasons why we might see the dip go quite deep, but also at this time of year it's spring and summer, and that always brings a nice boost to the property market. And will that just keep it afloat above the water? A lot of people try to predict, and news headlines with scaremongering, drops and crashes of around 40% this year. There was a lot of hype and it never really happened, surprise, surprise. And that's something that I've always been saying on this channel, and I still think today rings true. I don't think a 40% crash is going to happen. But of course, at some point, house prices had to slow down and almost stop, and if not go down for a little bit, because we have just gone through one of the hottest property markets seen in recent history. Prices were going up 1 to 2% every single month, and that's way too high. It's too much and it needs to come down at some point. What goes up must come down. But then on the flip side, on our tiny little island that we call the UK, there's only so much supply and demand. There's only so many houses that we have, and that's why house prices are always going up and up and up, because there's lots of demand, but there's not enough supply to meet that ever-increasing demand in this country. So what's happened in the property market so far? Now, as usual, I've used lots of different sources to piece all of this together, and I'll give you some of my ideas, thoughts, and theories as to what we're seeing in the property market right now. This graph from Zoopla Research shows a few different interesting things. What is it telling us? Well, let's start with demand. In purple versus the pre-pandemic era, demand is 14% higher right now. When you compare now versus this time last year, demand is almost 42% lower, which is good because the property market was way too hot last year, and that ultimately forced up a lot of prices. When looking at sales agreed, a similar story. It's up against the pre-pandemic and it's down versus this time last year. A clear sign that the market is definitely cooling down. While at the same time, in the opposite fashion, less homes are for sale today versus pre-pandemic, and there's more supply now versus this time last year. This means there's less demand, albeit still high, and there's more supply, albeit not enough, but it's kind of tipping in that right direction. And that ultimately and naturally starts to drive prices downwards. I wanted to mention today's video sponsor, Wise. When Wise approached me, I was quite excited because I've been using them for my business for a few years now, and I still do a lot of freelancing in US dollars and need to get it over into British pounds. Using Wise allows me to exchange money cheaper than the banks in my business, so I have international virtual accounts both for the US and for the UK. Now, I use their interest account where I get a 3.81 variable rate interest on my account balance. My account works just like a regular current account, so I can run my business like normal without locking away the funds. Plus, the 3.81 variable rate is way more than the banks offer on their accounts. Even though it's easy access using government-backed loans, any investment, even in a low-risk fund like these, are never guaranteed. Sign up below using the link and get your first transfer fee-free up to £500 for new customers only. So what about the UK as a whole? Well, over the past few months, we've seen the property prices dropping month on month, anywhere from 0.5% to 1 to 2% on a month, and so far has looked quite bad since property prices have gone down. However, we also see a natural seasonal impact that happened over the exact same period. Now, every time we run up into the darker nights and winter and the Christmas period, there's always a bit of a dip in the property market, which kind of hits a low around New Year's Day, and then it peaks all of a sudden as we get into the new year. People have new goals, think about what they want to do for that brand new year. And it's as we hit spring and summer that the demand really starts. And this is when houses are looking their best, the garden's looking great, it's full of flowers, and it's when houses can potentially get as much as possible. It means, as you can see here, we're still green all over the country year on year, with the highest performing areas in the Midlands and North still above 5%, according to the House Track data, which is published every single month. And now we're entering the busiest time of year for house sales. This could keep the demand for housing up just enough to keep those house prices propped up for a little bit longer. And the Bank of England bank rate has already now hit 4.5% as forecasted throughout the past few months, and I think it's going to stay here. But this is really starting to put pressure on a lot of people. It's making mortgages, car finance, credit cards and more a lot more expensive. Now that's a downwards pressure on the market because it means that people can't afford the mortgages as much because they're so bloody expensive right now. But we're at the peak and it can't get any worse almost than where we are today, which is a good thing. And banks have already priced all of this in already. The only major difference that I can see in the data is that inflation is still lingering a little bit higher than what the Bank of England thought it would be this time now. At this point, the Bank of England thought it would be around 9.5%, but in fact, we're looking at around 10.1%. So it's not far off, but it's still a little bit higher, which has prompted the Bank of England to raise the bank rate a little bit quicker, because we weren't expecting to see anything above 4% on the bank rate until later in 2023, and that's just happened a little bit sooner than expected, which is fine, and we'll probably end this year at some kind of peak at around 4.5%. It might even start to go down depending what happens on that all-important inflation figure. So are we on the brink of a dip finally? Now, looking at this latest data that's just come out from Halifax in their monthly house price index, the graph shows what's going on. This is based on mortgage approval data, and I'll draw a line at the zero benchmark to make it easier to see positive and negative growth. So the purple line is the monthly percentage change in house prices. In 2022, we were showing quite high month-on-month gains of almost 1% a month, which is quite high, but very quickly, towards the end of 2022, that turned negative for quite a few months, which ultimately, on the dark blue line, showing the annual year-on-year comparison, that started to bring the yearly house price growth downwards back into single-digit figures and down to about 2% as of recently. But after the property market boomed in Q1, it's been pushing prices up a bit further, and we're now seeing that cool off again, which has now left us in an almost zero flat property market right now, and it's on the brink of going either way. There are two forces kind of pushing upwards and downwards, which is really going to depend what happens next. The downwards pressure is that the Bank of England rate is still expected to go from 4.25% to 4.5% very, very soon. Now that means that mortgage rates may get a little bit more expensive, especially on the standard variable rates. They are very expensive right now. I don't think it will impact the fixed rates too much because a lot of the banks have already priced in a lot of this anticipated increase already by now. It's not as much of a shock to them, so it doesn't go up as much, but it still might happen. Ultimately, this is bad because it reduces people's affordability because mortgage repayments become so expensive every single month. They have to reduce the amount they can borrow to pay for that same house. Now, they either pay less money on the house through an offer or they put more of their own cash in. Now, the likely scenario is that people just offer a little bit less and that starts to drive prices down. On the other hand, we're entering what is going to be the busiest period of the housing year with lots of property activity, and that might just keep things propped up. If there's enough demand and people competing for nice houses, that'll keep those bidding wars happening and just keeping those prices afloat for a little bit longer. We're also seeing mortgage approvals dip as well. Currently, they're down 1.2% over 3 months and down almost 10% year on year, especially since the average 5-year fixed mortgage is now 1.82% more expensive at an average of 4.5%. Now that's really hard on families. What the reality of that means is that those who locked in years ago on really cheap 2% or sub 2% mortgages, on average on a 250k home with a 200k mortgage over 30 years, that means going from £739 a month up to £1,000 a month. Now that's an extra £261 a month that family have got to find on top of the cost of living crisis, more expensive fuel, more expensive food, which, by the way, I am sure food in the supermarket has definitely gone up way more than 10% over the past year. Now let's look ahead at the looming problem that some people are really starting to realise very quickly. Now on this channel and throughout all the videos I've done so far over the past few months, I've always stuck at around, I think it was going to be around a 10% drop in the property market year on year. And now a lot of people are predicting these big 40% crashes, but I just don't think we're seeing another 2008. It's a very different set of circumstances. But the big issue is what I just mentioned. It's those people who were on 2% fixed mortgages and are going to be coming off very soon onto a more expensive 4.5% mortgages, which makes a massive difference to monthly repayments. When families are already really struggling with the cost of living crisis, an extra £200, £300, £400 a month is pretty unaffordable for most people, and if anyone was saving money, they're likely now not going to be saving anything for emergency funds, rainy day, holidays. It's going to get very, very hard, on top of how hard it is already right now. But what this means is that for those who are starting to struggle and they're realizing that they need to fix on a brand new mortgage, they have a few limited options. They might have to sell their house to move somewhere cheaper to afford what is the similar monthly cash flow on the mortgage, but for a lower amount of borrowing because the interest rates are so high. That forces people to move. It means people have got to move quick, and they may accept a lower offer just so they can get moved sooner. On the other hand, it also means that people might just stay put. They might try and weather the storm, and that's always been my advice, is just find anything that you can weather for at least the minimum of the next 2 years until we can see rates start to settle. We're definitely hitting the peak now, so if you can wait a little bit longer, you could re-lock in the next year or two when rates do start to come down and have something that's a little bit more sensible. Either way, these are huge problems. They're massive downwards pressures on the property market, and I think will ultimately impact property prices until those rates do start to come down, and that's all dependent on inflation. When inflation starts to really drop, and I'll be very excited to see it go back to single digits, I think we'll be on the road to recovery in terms of some kind of sensible interest rates. It won't be as low as 2%, but it won't be as high as 4.5%, 5% like we're seeing right now. However, some positive news, we are starting to see the house price to earnings income as a ratio start to come down. It peaked at around 9.5 times. That's incredible. That means that houses typically are worth 9.5 times more our income, which means they are incredibly unaffordable, especially when mortgages only really cover 4 to 5 times our income to afford a house. It means to afford something more expensive, you either need a massive salary or you need massive amounts of capital to pay for that house and then just have a smaller amount of borrowing on the remainder of the property. I believe this is because of a mixture of private sector getting lots of pay bumps in that industry, but also, as we've seen with a lot of the strikes, a lot of the public sector workers are also starting to get pay bumps. So when you combine that with a mixture of house prices starting to come down from their peak, although it's still flat year on year, they have been coming down, that's contributing to the house price to earnings as a ratio, which is good. It needs to come down further, but it's on the right trajectory downwards to become a little bit more affordable relative to today. You also have to remember, and I read a lot of the YouTube comments on some of these videos, is that there's a wide spectrum of people in this country. To some, a lot of life right now is already horribly unaffordable. It's very difficult. The mortgage that's looming later this year with the new renewal is going to be an absolute nightmare. But there are also still a lot of people in this country who have good jobs, good incomes, they have solid financial resilience, they have good amounts of savings, and that is still propping up the economy right now. It's why we're not seeing house prices absolutely crash and plummet, because after COVID, people are still sat on a lot of capital and savings that they haven't been using. A lot more people are working hybrid or remote, so they're saving money on commuting and lunches and all of those costs associated with going to the office. So it might not feel like it to some, but to others, there are a lot of people in that situation right now where, yes, things are harder, things are more expensive, but they're able to weather a lot of that expense. And that's the joy of this channel, is that there are people from all backgrounds, which is great, learning about all of the finance things. But I think that's just one thing to bear in mind when I look through the comments, is that there are people in lots of different situations. One thing that is worth mentioning, and I saw this very recently this week in the news, which is 100% mortgages. Now, these haven't been seen since pre-2008, just before the massive financial crash. Now, we're not seeing the same thing here. It's a very different set of circumstances, but I'm not a fan of 100% mortgages. Interestingly, you only start to see them reappear into the market as a product when confidence is really, really high in the property market, because there is a massive risk of negative equity. Now, if you put a 10% deposit on a house and you have a 90% mortgage, if there's a slight dip in the property market, you would still have just enough money to pay off the bank loan if you needed to in the case of an emergency. But if you got a 100% mortgage and then property prices this year dipped 10%, you're in 10% negative equity on a house, which on 100k, 200k might then mean that you owe 10 to 20,000 pounds, meaning you're unable to sell your house or even remortgage onto something more sensible because of negative equity. It's kind of been branded as this whole big renting thing and stop the renting crisis and help people get onto the property ladder, and I completely get that and understand that. But I don't think 100% mortgages are the right way to go. Now, the WEF, the World Economic Forum people, will definitely be commenting below saying that you will own nothing and be happy. And yes, I kind of get all of that, but that's not what this is for. It's meant to help renters get out of the system. But the problem is right now, we're seeing in a lot of the data that mortgages are more expensive than renting. So it makes it harder for those who can't save up for a deposit anyway. They're going to be paying more for the mortgage, which then puts them at massive risk of negative equity because of the market right now. So as much as I'm not a fan of them, I do think it's interesting that it has appeared right now at this point in the market that specific lender is started to offer that product. It means that they have some kind of confidence in the market going forwards, and it might start to spur other banks to do the same thing as well. And that means that when you start to see all of this, that we are slowly in the next few years approaching a new peak to then see a proper property crash that will be well overdue by that point, because according to the 18-year property cycle, we're still a little bit short of where we need to be. So that might mean we might see a bit more growth and then a bigger dip and a bigger crash that's greater than 10%. No one really knows. I'm just looking at ideas and theories and data and trying to come up with some kind of story that makes sense to me and to other people and showing what I think, so hopefully you'll take some use out of that. But either way, it's a really interesting time right now. We're on the 0% mark of property prices. It really could go either way next month because we're at that pivotal point in the year. It's a cyclical thing that happens and we'll see which way the property market is going to go. But either way, I think in times like this where there is a general sentiment of fear in the market, it also means that there is opportunity to be had, whether you're a first-time buyer, a mover, an investor. There are properties coming up on the market at good prices that aren't being outbid and massively competing against each other. So there are good deals starting to appear, and now is the time to start looking if you are having a look. Speak to a broker, understand your mortgage affordability, and get out there and have a look and see what you find. You might be surprised. Let me know what your property plans are. Drop a comment below and tell me everything you're doing at the moment in the property world. I'd love to hear what everyone's doing. I find it really, really interesting. If you enjoyed this video, then check out this one here, which are the top mistakes that first-time buyers make when buying their very first home. So check it out here, and I will see you in the next video.